Brad Williams, Frugal Finance. You want to own real estate, but you don't have a lot of money to get started. What options are available? Well, there are products out there. They're called real estate investment trusts. They're alternatives to ownership. And one that comes to mind long ago was public storage. When I was in the industry, when I was a broker long ago, public storage offered real estate investment trusts where we could buy into the self-storage facilities. Well, real estate investment trusts will do the same with apartment buildings or warehouses. Prologis, for example, is a huge real estate company, and I think they may offer real estate investment trust. Maybe they did in the past. But what it is, investing in real estate can be a good way to diversify your assets. But if you don't want the responsibilities that come with ownership, real estate investment trusts can provide exposure to real estate without requiring you to actually buy or sell property. Established in Congress in the 60s as a way for individual investors to invest in large-scale income-producing real estate, REITs are companies that own or finance income-producing real estate or related assets. Today, there are REITs that own everything from office or apartments to hotels to mortgages or loans, with many specialized in a single type of real estate, such as retail, residential, or industrial. Some REIT products are more complex than others. Research the different types of REIT investments and make decisions based on your overall investment goals. Understanding the basics, there are three types of REITs. You have an equity REIT, which they typically own and operate income-producing real estate. They have mortgage REITs, providing financing to real estate owners and operators, either directly in the form of mortgage or other types of real estate loans, or indirectly through investments in mortgage-backed securities. And then you have a hybrid REIT, uses investment strategies of both equity REITs and mortgage REITs. REITs are classified as follows. Publicly traded REITs are bought and sold by investors on national security exchanges, just like individual shares of public company stock, and are regulated by the Securities Exchange Commission. As with other publicly traded securities, investors can purchase REIT common stock, preferred stock, or debt securities. Public, non-traded REITs are regulated by the SEC but are not traded on a national exchange. These REITs typically fall into one of two buckets. Net asset value REITs, which have become more common, regularly calculate the value of the holdings in their portfolio and offer to sell or redeem shares in the REIT based on the latest NAV per share. Their fixed price REITs offer shares at a set price. These publicly non-traded REITs typically appraise their asset far less frequently than NAV REITs, perhaps once per year, and tend to be less liquid. And then you have private REITs, are neither regulated by the SEC nor traded on national exchanges, and are primarily sold to institutional or accredited investors. I'll talk about accredited investors in another video. Investing in REITs, there are a number of reasons investors might gravitate to REITs. In addition to offering diversification, REITs hold the potential to provide a stream of dividend income, since REITs must distribute 90% of their taxable income to shareholders in the form of dividend. Publicly traded REIT shares might also increase or decrease in value, such as any stock, though dividend income tends to drive REIT investments rather than appreciation of capital. You buy and sell publicly traded REITs as you would any stock. All REITs come with fees and expenses as well as risks, including the risk that your investment could lose some or all of its value. Other REIT risks vary depending on the type of REIT you own. For example, publicly traded REITs tend to be more liquid, but also more prone to price swings, volatility than non-public REITs. Changes to interest rates, property values, and the economy may also affect return on the REIT's investment. As with any investment, it pays to do your research since each REIT is different. Before investing, research the registration status and review recent filings of publicly traded and public non-traded issuers using the SEC EDGAR database, and consult a tax professional to understand the tax implications of different REITs. For investors seeking exposure to real estate, another option is to invest through REIT mutual funds or exchange-traded funds. These products generally offer a basket of REITs that provide broader exposure to real estate investments than can be obtained from a single REIT. A final word of caution, REIT fraud is real. Sales tactics might include using false information, overpromising returns, and underpaying risks. Promoting REIT-like products that are in fact not REITs and have less liquidity and additional areas of risk. Carefully read all supporting material and consider seeking input from an investment professional before making this type of investment. Comment. Let me know your experiences with REITs, success, failure, good, bad. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.